a sudden jump to 15.76. That is exactly where the VIX Fear Index is sitting right now, surging nearly 4% in just a single day.
Hello everyone, welcome back to AI Market News. Today, we are diving into a market landscape that is completely defined by surging energy costs and sliding equities. We are going to break down exactly what all of us need to be prepared for next.
As we can see in the chart, U.S. markets really extended their losing streak based on available data. All three major indices closed lower. The Dow dropped 0.51% to roughly 53,465, and the Nasdaq slipped 0.27% to approximately 26,657. For beginners, the mechanism here is actually quite straightforward. When global uncertainty rises, market participants tend to yank their capital out of riskier assets like stocks, and that causes these broad market declines.
So what is the primary catalyst for this pullback? It is the energy sector. Just look at the graph showing this significant upward trend. WTI Crude just surged to around $84 a barrel, while Brent topped $91. This massive spike is directly tied to a sharp deterioration in Middle East diplomacy. The why behind this is pretty simple. When the global supply of oil is threatened, the price of crude inevitably shoots up. That creates a massive ripple effect impacting everything from manufacturing to transportation costs for all of us.
According to current market information, President Trump rejected an extension of the 60-day ceasefire agreement with Iran. In response to that, Tehran warned they might shift to a fully offensive military posture if diplomatic efforts totally collapse. This puts the Strait of Hormuz directly back at the center of geopolitical risk. Why does this matter so much? Well, roughly a fifth of the world's oil passes right through this narrow waterway. So any disruption there creates an immediate massive supply shock, which naturally drives energy prices even higher.
And this energy shock brings us directly to the bond market. The graph shows a really sharp climb in the U.S. 10-year Treasury Yield, which has suddenly spiked to 4.74%. The underlying mechanism connecting all these events is inflation. When oil prices rise, they stoke broader inflation across the entire economy. To fight that, central banks have to maintain higher interest rates, which then pushes bond yields up. As a result, borrowing becomes way more expensive for companies, and that definitely cuts into their future profitability.
This entire bond sell-off reflects what we can only call a toxic mix of macroeconomic factors. Beyond those surging energy costs we just talked about, we are observing a massive AI-driven borrowing spree by technology companies, and that is coupled with persistent government deficits. When government bond yields start offering such high, guaranteed returns, those expensive, high-growth tech stocks become much less attractive to all of us. Capital simply rotates out of those risky equities and flows right into safer yields. Bringing this impact home to Japan, we can observe a really severe reaction. The Nikkei 225 plunged 1,759 points. That is a 2.5% drop, down to 67,461, completely snapping a 5-day winning streak. Semiconductor and AI stocks absolutely bore the brunt of the selling here. This is a classic contagion effect. Rising global yields made high-valuation tech names in Japan look increasingly expensive relative to safer assets, and that triggered a broad, very aggressive sell-off.
Adding even more pressure is the underlying economic weakness in Japan. The Q2 GDP came in at an annualized growth rate of just 1.1%, which fell well below the 2.5% consensus. The main reason for this miss is deeply rooted in declining consumer spending, alongside a drop in business investment. When everyday people and corporations pull back on their spending, it totally stifles overall economic growth. That leaves the stock market highly vulnerable to the exact kind of external shocks we were just discussing.
Now, for those of us closely monitoring the currency markets, the USD/JPY dynamics are absolutely crucial right now. The pair is currently navigating extreme pressure. The underlying mechanism driving this is a widening yield gap. U.S. Treasuries are rising, while Japanese government bonds briefly touched a 30-year high of 2.945%. Because capital naturally flows towards higher interest rates, this massive gap between the U.S. and Japan heavily influences the continued strength of the dollar against the yen.
Meanwhile, recent U.S. economic data is presenting a pretty conflicting narrative. On one hand, the August Empire State Manufacturing Index surged to 20.60, which indicates really robust factory activity in the New York region. But on the other hand, July retail sales showed a concerning 0.6% decline.
This sharp drop in retail sales raises some serious questions about consumer resilience. If consumers stop spending, the broader economy loses its absolute primary engine of growth. To really understand where the markets are heading next, we must look to the economic calendar. Tonight at 8:30 a.m. Eastern Time, we will see July housing starts and building permits. Then on Thursday at 8:30 a.m. Eastern Time, weekly jobless claims will be released. And finally, on Friday at 9:45 a.m. Eastern Time, the S&P Global Flash PMIs arrive. These key indicators will definitely help all of us gauge whether the broader economy is successfully weathering this high interest rate environment.
But the absolute main event for all of us this week arrives on Wednesday at 2 p.m. Eastern Time. That is the release of the FOMC minutes from their July meeting. Remember, the July decision to hold rates steady at 3.50 to 3.75% was a really close call. We actually had 3 members actively dissenting in favor of a hike. The market desperately needs to know how many other members were sympathetic to raising rates, because this is going to completely set expectations for the upcoming September meeting.
Ultimately, the Federal Reserve is facing a wildly difficult dilemma right now. They have to balance a resilient labor market and sticky inflation against Middle East-driven oil shocks that threaten to slow down economic growth. Wednesday's minutes may reveal just how tough this balancing act has become. The real question we are left with is this: if inflation heats up while the economy cools down, will the Fed be forced to make a massive policy mistake? As market participants, we must stay nimble in the face of these competing forces. Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.